Hello and welcome to part 4 of our 2021 SASB Standards Implementation webinar series. In this session, disclosure quality, including governance, controls, and assurance. I'm Neil Stewart with the Value Reporting Foundation, speaking to you from New York.
I'm Dan Gelzer. I'm a retired partner in the law firm of Baker & McKenzie and a member of the SASB Standards Board, and I'm in Washington, D.C.
And I'm Suzanne Stormer. I'm also a member of the SASB Standards Board, partner and head of sustainability at PwC Denmark, based in Copenhagen. Pleasure to be here.
Welcome also to our audience from around the world. More than 3,000 registrants for this series, representing upwards of 45 countries. Around a quarter are sustainability consultants, another quarter or so corporate sustainability officers. We also have investors, accounting professionals, academics, legal officers, and investor relations officers. We started out this series in session 101, going back to the basics, the foundation of SASB standards, looking at industry-specific financial impacts of ESG factors. Bank of America Equity Research and BASF spoke. In session 201, we looked at the corporate journey with Lockheed Martin and ABN AMRO from the Netherlands. Incidentally, both BASF and ABN AMRO were integrated reporting pioneers, and so now really are great examples of using both integrated reporting and SASB standards. Last week, we focused on investors, why and how they want companies to use SASB standards for reporting to investors. And Canada's PSP pension fund represented the asset owners, UBS representing asset managers. All the webinar videos are available in case you missed them. Today, in the final convening of the SASB Standards Masterclass for this year, we're looking at disclosure quality, internal governance and controls, external assurance. What makes for investor-grade ESG disclosure, and how do you get there? This will help businesses put in place the structures necessary to implement SASB standards to drive sustainability information that is decision useful for investors and management and boards. We invite participants to submit your questions throughout the program. We'll take as many as possible. Please use the Q&A function in Zoom. We're focusing on SASB standards implementation, so I'm sorry if we don't have time to respond to other questions that might be outside of that scope. Now, before we get started with our expert speakers, I'm going to quickly field some of the frequently asked questions from the previous episodes of this implementation series. So first up, can SASB, GRI, SDGs, TCFD, other frameworks be integrated by companies since they're working off the same data pool? Now, companies can and often do combine frameworks and standards. And perhaps the best example would be GRI and SASB. And GRI and SASB have been working together to support companies that want to communicate with various stakeholders using both the GRI standards and the SASB standards. And in a recent publication, we highlighted which companies are already using the sets of standards together, demonstrating the complementary nature of these standards. So I recommend that report, so you can see that there. What concrete steps are being taken to develop common metrics for measuring ESG to achieve uniform reporting? I'd like to point out that there is a tremendous amount going on, a lot of work taking place towards harmonization and convergence, including through the recent merger forming the Value Reporting Foundation from SASB and the International Integrated Reporting Council, and then work with the regulators, including the EC, with the IFRS Foundation, with the SEC. I do recommend a blog by our CEO, Janine Gilliott, recently looking at the work of the so-called Group of Five frameworks and standard setters, setting out a vision for what a comprehensive corporate reporting system will look like in the future. Next, here's a common one we get. How do companies without a significant energy input or greenhouse gas emissions, for example, healthcare delivery, prioritize SASB disclosures? This area requires investment, but if we don't disclose, there seems to be an outside ding on the rating side. Well, I can tell you, first of all, that it's true in healthcare delivery, scope 1 greenhouse gas emissions are not material in the SASB standard. But in terms of climate risk, energy management is material in that industry. That's the management lever. Energy management really is the lever that relates to scope 2 greenhouse gas emissions. I recommend our climate risk bulletin, climate risk technical bulletin that we recently put out. This maps the 77 industries to the SASB, to climate risks, physical, transition, regulatory risks. So you can identify what are these risks, and what should companies be reporting beyond scope 1 emissions, which are material in a minority of the industries. So energy management and waste management are clear transition risks for healthcare delivery. Climate change impacts on human health and infrastructure relate to the physical impacts of climate change for healthcare delivery. So just as an example there. And in terms of rating, the rating question, remember that SASB is not rating companies. We just provide the materiality mapping. It's up to investors and others to assess what's good or bad and weight their assessments. One would think that the ratings firms are doing a similar kind of process as SASB is, that is determining what impacts performance, and perhaps determining that, at least in the case of healthcare delivery, scope 1 greenhouse gas emissions shouldn't matter to the rating. Moving on, and how many or which companies in different industries are using SASB standards? Simple answer to that, we list them on our website. Recently, we revamped our website to make it easier to filter by industry and by country. Should you wait to report until you have all the data and programs recommended by SASB standards that in place, or should you report on what you have, be transparent about what you're lacking? SASB standards application guidance, which is a concise document covering all industries, makes it very clear that we recognize this is a developing field, ESG reporting. You may not yet have all the data to report to your standard, or for that matter, the data, the topics or metrics in your standard may not be relevant to your business model. In the case of any omissions or modifications, simply indicate so and give the rationale. What if a company is here's the next question, and what if a company is involved in more than one industry? For example, technology and healthcare. Should you choose one SASB standard or report on both? I would recommend getting some guidance from our implementation primer, showing how companies in more than one industry can easily use more than one industry standard. Many companies, for example, in financials, where you have commercial bank, asset management, brokerage under one roof, will report to those 3 standards. One of my favorite examples is State Street Global Advisors itself. In their corporate reporting, their ESG report reports to the asset management and the health software and IT services standards. So a good example there. Well, let's go now to our first expert conversation and welcoming Suzanne Stormer. And as Suzanne introduced herself earlier, she's a member of the SASB Standards Board. This is the independent board that is accountable for the due process, outcomes, and ratification of the SASB standards. And Suzanne is a partner with PwC, leads the sustainability advisory and assurance practice in Denmark. And before this position, she was with the Danish healthcare company Novo Nordisk. And having pioneered integrated reporting at Novo Nordisk, Suzanne was recently appointed as an integrated reporting ambassador for the Value Reporting Foundation. So Suzanne, let's start by looking back at Novo Nordisk's ESG journey. And perhaps you could introduce us to the kinds of structures and procedures that you put in place so your reporting would be decision useful for management, investors, and other stakeholders.
Yes, very happy to, and thank you, Neil, for the opportunity to contribute and share what we often refer to as our pains and our gains in this process. So we were early adopters of the notion of integrated reporting, and that goes way back to 2004. So that was even before the birth of the IRC organization. The driver at the time was really internal, that we had been updating the bylaws of the company to specify that we will do business in accordance with the triple bottom line principle, and therefore it was only natural to also report against that. So that was our occasion to bring together what was previously a standalone sustainability report and a standalone financial report. And I think it's interesting that these days many companies, certainly in Europe, with the upcoming legislation will be going through the same kinds of deliberations. So therefore, I think this old case is still relevant. So what we did was that our audit committee then wanted to get comfort that the information we provided, putting it in a table face to face, the financial data and the environmental and social data, to get comfort that the quality was equal. And we therefore set up a procedure where we collaborated with internal controls, with internal audits, with the accounting team, as well as my team, the sustainability team. And we developed a roadmap, and we took a 3-year process of upgrading the data points. And in that process, we weeded out a lot of data points that were just not robust enough to pass the test. We used the COSO framework, and we also leaned on the process that we had just gone through for financial reporting, inspired by the Sarbanes-Oxley procedures of building internal controls, and that was a major whole. But the outcome was that we had an audit committee that was happy with the quality of the data, that they felt they could trust the information. And as we had been, as I said, weeding out, we also were left with fewer KPIs that were intended to be decision useful and cost effective, fully in line with how SASB's current framework looks.
It's incredible to hear about this alignment between internal controls and accounting and sustainability teams, really, and you leaned on your SOX team, the Sarbanes-Oxley, who have been doing those internal controls. And in the end, tell us a little bit about how this benefited Novo Nordisk. As you suggested, this brought reliability to the information. Did this really become a kind of edge for the company?
Yes, I believe it did, because I think for anybody in the audience who represents the sustainability profession, I'm sure that you will have felt this need to get recognition by the top tiers in your organization, and increasingly the board of directors and the audit committee will be involved in oversight of your sustainability reporting. And as I did mention, this is most likely going to be the general practice for companies operating in Europe, with the new corporate sustainability reporting directive to be effective as of 2023. And the benefit is that you have fewer and better disclosures, and that you can rely on those disclosures as being of a quality where they are, complete and meeting the requirements that you would also have of financial reporting. So I think that notion of getting this information on par really raises the perception of the importance of sustainability information, and also enables, for instance, investors and analysts to compare the data, so they can look at what is on one page, the cost of goods sold, and on the facing page they would have the carbon emissions, and they can see the correlation. They can make the analysis themselves, just like what you said before, Neil, on what companies do when they follow the SASB standards.
Now, building on that, so thinking that's governance and internal controls and the advantages, the benefits they bring both to the companies and to the investors. Building on that, an additional element of the CSRD that you mentioned, the new regulation in the EU coming very soon, is mandatory assurance over ESG reporting. This is something that many companies might see as a cost or a burden, but does that also benefit the company in terms of perhaps improved processes and the decision usefulness of the data.
Yes, it does. And here at PwC, we take pride in building trust in society, and what the assurance process does is really to ascertain that you have an independent body that reviews the data, so that the public can trust the quality of the information. And the value of the assurance process, and this is something that I always emphasized also before I joined PwC. The value is not in the statement itself. The statement is what is facing the public. The value really lies in having somebody who can be a friendly challenger to your processes, and I can certainly reveal to you that we had many conversations with it was PwC at the time that was our assurance partner. Many conversations with them on the internal controls, on the packages, the way we put it together, and it did improve the processes quite significantly. So it is very very helpful. And I see the value also in ensuring that the data that you end up with is robust, and that the people who are involved understand that it's just not an arbitrary number we are asking them. We actually ask them to be disciplined in how they collect, how they ascertain the data. So the internal process is absolutely vital as well.
Let me ask you an additional question about for companies just starting out. What would be your advice for a smaller company with fewer resources and personnel? Novo Nordisk, obviously a global, international, very large cap company with resources and personnel. But how can a smaller company starting out establish internal controls over a lot of ESG data without the same level of resources?
Well, I think that the key here lies in a lot of ESG data, because I think for many companies, ESG data have simply mushroomed. Whenever somebody asks for a data point, then companies try to accommodate and deliver. What we do when we advise clients who may be in fitting that characteristic that you give, maybe not so mature, maybe not with a global reach, is to start looking at the SASB disclosures that apply to that particular sector, because that is already a smaller gross list of disclosures, and then to think about how would this piece of information that we provide, how does that help us make better decisions? And to the point about decision usefulness, I always emphasize that they have to be decision useful for the users, but as importantly for the management. So it should help us steer the company so that we know that by providing this piece of information, we will use it to act differently, or how we manage our resources and allocate our resources. And I think this is where what we have seen with the integrated reporting framework that we became an early adopter of, that we've been using that framework and then also seeking inspiration from the SASB standards already from the outset. So that is a way of providing a backbone for you. But at the end of the day, it has to be the management or the people who are authorized by management, like myself, to make that cut and make it meaningful.
It's a really good point, and it's one that we've been emphasizing with the formation of the Value Reporting Foundation. That the point being that ESG reporting is not an end in itself. It's about performance, right? It's about driving the creation of value, preservation of value, and about improving performance. Suzanne, thank you very much for helping us set the scene. We're going to be circling back to you afterwards for Q&A, but right now I'm going to go on to give you a little bit of information, some signposts really about both internal controls, data governance, as well as assurance. And to start off with, I think it's important to look at how SASB views ESG information and the kinds of reliability or quality needed. And I'll quote Mark Wiseman, the former CEO of the Canada Pension Plan Investment Board and former head of active equities at BlackRock. This data is being used in investment decision-making. It's being used in management decision-making. It's as important as financial data. Therefore, it needs to be treated culturally the same way that financial data is treated. That includes the whole system of infrastructure, the gravel under the road, Mark calls it, the foundational layer being standards, but also internal audit functions and third-party attestations. This whole view is built into the SASB standards. And so our standards application guidance, which I referenced earlier, says that disclosure to investors should be accurate and reliable. The company should design, implement, maintain a system of governance around that information, including management involvement, board oversight, and internal control that is substantially similar to what it uses for financial reporting. And the SASB standards, although they conforming with the standards does not require third-party assurance, external assurance, the standards are designed to serve as a basis for suitable criteria if a company chooses to seek third-party assurance. So let's explore this a bit. This webinar won't be an exhaustive guide to governance and internal control, but we will give you some signposts and key resources. And first, let's just start with thinking about an overview of the structure needed around ESG reporting to make this virtuous circle of improvement. And it really does start with governance, board oversight, even performance-based incentives. We're seeing more and more ESG tied to executive remuneration. Then materiality. What is material to shareholders, to stakeholders? That process involves shareholder or stakeholder engagement and evaluating and embedding ESG into strategy as well as risk management, determining the appropriate metrics and goals, defining suitable criteria for that objectivity and reliability and consistency of information, and leveraging different standards or reporting frameworks, including, for example, SASB standards and integrated reporting framework, and standardizing data collection, formalizing those processes and controls, internal audit, and getting internal and external assurance. So, this whole area is taking on new importance as we move towards mandatory ESG disclosure, starting out with climate risks in the US, it appears. In the EU, we now are moving towards mandatory ESG disclosure for a much larger population of companies. Now, interestingly, over the last week, I've been reading responses to the SEC's climate consultation, and one chief accounting officer pointed out, he said that climate-related disclosure must be supported by system architecture and infrastructure to support the collection of data, its measurement, processing, and reporting. And that's going to require new data attributes, new databases, new system functionality. That systems and processes have to be designed, built from the ground up at admittedly significant cost. At the same time, control standards will be needed. And many believe that those standards need to be in line with those mandated for financial disclosures by SOX. Those should be mandated. Others point out that they'll need to be calibrated differently based on materiality and other considerations. So this CAO said that the SEC is really going to have to guide companies on control standards and how to build systems, the right control environments. And it's going to take a lot of time and a lot of investment. But let's start to look at some of these controls and some of the things that need to be put in place. The information management systems, training, instructions for the people around the company providing the data, an approval process and document retention, review of materiality and material indicators, regular internal audits, third-party verification of certain data, for example, greenhouse gas emissions, and then perhaps outside audit services, review of all or selected data, the executive approval process, and the management review, executive sustainability committee, for example, or disclosure committee. It could be environmental health and safety. It could be a board committee responsible for sustainability, perhaps the nom-com committee or the audit committee. All right, so I'm now going to give you some signposts to delve into this more deeply. And thinking about it from the enterprise risk management side, thinking about it from the COSO framework point of view that Suzanne mentioned, you may find that you already have the structures you need. Today, they're around financial reporting. So Suzanne referenced the COSO framework. It's one of the most widely used frameworks for establishing internal controls, for evaluating, maintaining their effectiveness. It was developed in the early 90s by the Committee of Sponsoring Organizations, or COSO, and it defines internal control as a process affected by an entity's board of directors, management, and other personnel, designed to provide reasonable assurance provided regarding the achievement of objectives around operations, reporting, and compliance. So COSO's internal control integrated framework is intended to help companies through this process. It includes specific reference to non-financial reporting objectives, suggesting that they can be integrated into a company's existing internal control framework. The paper on the right explores how companies are practically applying the COSO framework and internal controls to sustainability metrics like those included in the SASB standards. And it includes an excellent case study on Novo Nordisk, Suzanne's former company. Now, key to this is the discussion around ESG risks as business risks. The data has to be decision useful for investors and management. Again, as Suzanne described, this guide shown here by the World Business Council for Sustainable Development and FSR Danish auditors gives practical suggestions on how companies can improve the quality of and confidence in their ESG information with the basic building blocks of internal controls. Let's turn to external assurance now, and we see assurance of ESG reporting on the rise, definitely among SASB reporters, as you can see on these charts, from around a quarter of reports in 2019 to more than upwards of 40% in 2020. The rate may be going even higher in 2021. A new report released last week by IFAC, that's the International Federation of Accountants, along with AICPA and CIMA, found that over 90% of the world's largest companies report some level of sustainability information, and 51% of those get some level of assurance. Worldwide, 63% of assurance engagements were conducted by audit firms, overwhelmingly with the ISAE 3000 assurance standard, and generally being limited assurance engagements. Interestingly, among SASB reporters in the US, we find the use of audit firms to be higher than among non-SASB reporters, perhaps indicating closer alignment with financial reporting. So driving this rise in insurance, it's the convergence with a financial reporting process that we've been talking about, and reiterating here on this slide the standards application guidance I showed earlier. SASB engages regularly with the AICPA's Sustainability Assurance and Advisory Task Force to evaluate the SASB standards technical protocols and strengthen the standards as a basis for suitable criteria. Investors in forums that we've been part of have acknowledged the value of assurance. And I'll give you a couple of quick examples just to show you kind of what it looks like. Vornado Real Estate Company is a great example, getting assurance for both its GRI index and its SASB table. In the case of the GRI index, it's an examination, it's a review or limited assurance, and in the case of the SASB table, it's reasonable assurance. Etsy, another one of the very few companies that today is including a full SASB report in its 10K. It's an excellent example with 3 years of data. Etsy gets assurance on certain of its ESG metrics. And interestingly, although it doesn't name PwC in its 10K, does provide the assurance letter on its website. So thinking about assurance around SASB standards, there really are these, or around any ESG information, you could think of two levels of assurance, just to give a little bit of background here. A review, engagement, or limited assurance and the examination level or reasonable assurance. And as we mentioned before, that what's being mandated in the EU now under the new CSRD is limited assurance. Once assurance standards are in place for the EU, then reasonable assurance will be required. And there is now this question around for any reporting mandates that the SEC introduces, what will be the assurance requirements there? So some resources on assurance, first of all, again, from WBCSD in collaboration with ICAEW, an excellent buyer's guide to assurance on non-financial information. Recent publications this year from AICPA and CIMA, along with the CAQ, that's the Center for Audit Quality, a roadmap to attestation for audit practitioners, and also a special focus on effective governance over ESG reporting, both excellent publications. And new this year, also guidance from the IAASB, which sets the most commonly used accounting standard, ISAE 3000. Guidance here on extended external reporting, which includes sustainability reporting. This guidance includes an illustrative SASB example. And again, going back to the IFAC AICPA CIMA report released last week on assurance, 88% of assurance engagements worldwide currently use the ISAE 3000 assurance standards. Finally, on integrated reporting assurance really differs from other forms of ESG disclosure assurance, given that it's largely future-oriented and related to all elements of a business. But the integrated reporting framework does include suitable criteria for assurance of qualitative narrative disclosures. And the report linked to on this page came out earlier this year from IFAC and the IIRC, outlining the process and highlighting 8 organizations that have already gotten assurance for their integrated reports. So like I said, not an exhaustive coverage of assurance and internal controls, but hopefully some useful signposts to help you in your journey. Now let's go on to our next expert to continue the discussion. And Dan Gelser, like Suzanne, is a member of the SASB Standards Board. He has been with the board since it was created. Dan retired from the law firm Baker & McKenzie. Previous to that, he was general counsel of the SEC, and he was a founding member of the PCAOB, the Public Company Accounting Oversight Board, which was formed in 2002 after the Sarbanes-Oxley Act. And Dan, first of all, maybe you could tell us some stories, and from your experiences outside counsel, what are the risks of poor quality ESG disclosure and outside a framework of standards and governance and controls?
Sure. Thanks, Neil, and I appreciate the chance to be part of this webinar, and I'm glad to see so much interest in these topics. There certainly are a range of risks, I think, in making ESG disclosure without using the same kind of care and processes that surround traditional financial reporting. And as you suggest, we did see some examples of this when I was in private practice. And I think often when companies begin their sustainability reporting journey, if I put it that way, what they tend to do, in some cases, is to have the investor relations department perhaps, or someone charged specifically with corporate responsibility disclosure, prepare a report, but without much input from the rest of the organization. And in many cases, little or no board involvement, general counsel involvement, CFO involvement. We certainly saw situations where people like the general counsel were surprised to learn that the company had a sustainability report, and even more surprised to learn what was in it and what was being described as the reason outside counsel would get involved usually was because some problem had come up as a result of that, particularly questions about the accuracy and reliability of the information. So I would really urge people to avoid that situation. But so a little bit more specifically in terms of the risks, there certainly are legal risks. As ESG information is increasingly recognized to be material to investor decision-making, inaccurate ESG information carries the same legal risks as inaccurate material financial information might for the company. Another variation on that, I think, is inconsistency with information in regulatory filings and the information in sustainability reports or other kinds of ESG disclosures. In fact, the SEC here in the United States announced a month or two ago that it had formed an enforcement task force to look at climate disclosure and other kinds of ESG disclosures that companies were making. And my understanding is one of the main things they're going to focus on are differences between ESG disclosures and statements in regulatory filings. So I think that's really a pitfall and one that people need to have systems and process to avoid. I would say, though, that in terms of risks, the non-legal ones are perhaps even bigger than the legal ones. There's certainly severe reputational risk for a company that puts out inaccurate ESG information, puts out ESG information that then's shown to be inaccurate and has to be corrected in some fashion. And that can really destroy trust with investors. And I think there's just a practical aspect too. If your ESG reporting isn't reliable, you're likely to face a lot of one-off inquiries from institutional investors and others about your ESG performance, which is very time-consuming and costly for companies to respond to.
Some great points there, Danny. You know, it's interesting to think about that. It's not just inaccurate information, but that the risk of inconsistencies between different channels of reporting. And as you say, as we begin to see more and more climate risk, for example, enter into regulatory filings, are they saying the same thing that the sustainability report says? And now the SEC cracking down on that here in the US.
Yeah, it'll be interesting to see what the SEC finds, but I would suspect that we'll hear about some cases eventually of exactly the kind you're describing.
So let's turn to the SASB standards now and think about how they were created and how they're structured to really allow for this rigorous investor grade ESG reporting. What are some of the characteristics of the standards that drive this quality?
Well, yeah, when you say rigorous and investor grade, I would think of that as meaning disclosures that lend themselves to being subject to controls and to third-party assurance. So, you know, the sorts of things that we've been talking about. And as you pointed out a couple of times, the application guidance really urges companies to put in place the same sort of governance and control systems around their sustainability disclosures as they have for their financial disclosures. And I think the board does also bear that in mind and try to create standards and specifically metrics that lend themselves to controls. The roadmap for how we do that is in the board's conceptual framework. The conceptual framework is undergoing some revision at the moment, but certainly the basics of it aren't changing. And I guess a couple of things I point to are that in selecting frameworks, one thing that we aim for is verifiability. That is that whatever calculation or whatever disclosure the metric calls for can be replicated by anyone applying the guidance. That kind of verifiability, I think, also lends itself to having controls and to external assurance. I would say it comes largely from the technical protocols that accompany the metrics, which define the terms in a metric. In some cases, you know, provide a specific direction as to how something should be calculated or developed. Other metric characteristics that I think are important in this area are comparability and neutrality. We try to select metrics that will permit people to compare performance between companies. So if companies apply those metrics, the results will be something that'll give a picture of differences in their performance on whatever it is that is being measured. And neutrality means that the metrics are free of bias or value judgment. They try to give an objective picture of performance. I think all these things together drive us in many cases to quantifiable metrics rather than qualitative or descriptive metrics, but in either case, the kinds of disclosures that can be subject to controls and that auditors or other third parties can verify.
Excellent. Thank you for that rundown. Now, I'll ask you a question we also discussed with Suzanne, and that's that as companies consider the cost of assurance, third-party external assurance, what are the benefits that come to the company?
Yeah, well, so benefits of assurance, of course, have long been recognized in the area of financial reporting. We've had requirements for assurance over financial information for almost a century in the United States, and there was assurance even before it was required. But I think many of the same principles apply to the value of assurance over ESG information. Probably the main one, or the most obvious one, I suppose, is that it increases the confidence of investors and lenders, other providers of capital, over the information that the company is providing. As I said earlier, ESG disclosures are increasingly important now in investment decision making, and investors are simply more likely to commit capital to a company if they can have confidence in the information that they're relying on to make the decision. To say it another way, I think it lowers the cost of capital for a company to obtain assurance over its ESG disclosures. Some other things are worth pointing to also, though. First, while our focus is largely on communication with investors, there are certainly other kinds of stakeholders that want and use ESG information: the company's employees, communities in which it operates, regulators, NGOs, a host of others. And it can be important to them also to have the confidence in the information that assurance provides. And then finally, I'd emphasize a point that Suzanne touched on also. Assurance is often important internally to the company itself, in part because the process of having an auditor or some other party review information often produces advice about the controls that surround the preparation of the information and company systems, and that can be very valuable. And there are certainly cases where the company wants the assurance for internal reasons. I mean, I think you mentioned earlier that compensation is more frequently becoming linked to ESG disclosures. If the board, for example, is thinking about the CEO's compensation, they may want to have the benefits of assurance that the information they're basing those decisions on is reliable and accurate.
Excellent points, Dan. Yeah, when you start to think about the CEO pay or lending covenants, we see more and more green bonds, sustainability bonds. The assurance could really be very, very important in these considerations. Well, I'm going to now move on and share some information about more information about the SASB standards, how they're constructed and how they enable disclosure quality. And again, Dan, I'll circle back to you in a few minutes for Q&A with Suzanne. But right now, let me explain some points about SASB standards and disclosure quality. And the first point would be that companies are reporting SASB in a variety of different channels. There's really no single one chosen or right channel for SASB disclosure. It determines on a company's circumstances, their needs, their stakeholders' needs. We see SASB reports and annual reports and integrated reports and standalone SASB reports. And as a result, there is quite a wide variety of formats and also, let's admit, a wide variety of different quality standards of the disclosures. And for, just as by way of an anecdote, as we see, sometimes we see ESG disclosure moving towards mandatory, like in the EU or with the SEC in the US. That's when we start to hear companies, when they start to think about the possibility of ESG disclosure being in regulatory filings, then you get more and more questions, for example, about assurance. But here at the Value Reporting Foundation, we are beginning to deliberately assess SASB standards disclosure quality. We are monitoring the quality of disclosure with a view to improving the decision usefulness of SASB standards disclosure very broadly. So we're analyzing how the disclosure was implemented, and the goal is twofold. First of all, to inform our standards setting and maintenance process, identifying potential revisions to the SASB standards. For example, if a if a metric in an industry is always omitted or always modified, then that might signal a need to revise that standard. We also want, though, to work with companies and investors to identify best practices, to provide case studies to the market. Now, what are the elements that we're looking at? Here are 5 key ones. Are all the metrics and activity metrics referenced in the report, and tied to that is report or explain used? And the reason for that, again, it goes back to something I mentioned earlier in the standards application guidance. If omitting or modifying a metric, explain why and indicate that it's being omitted or modified. This is report or explain. There are many good reasons not to report on a particular metric or topic within your primary industry standard. It could be that it's not relevant to your business. It could be that you don't have the data yet, but plan to. Or it could be that you're not reporting it for competitive reasons. Whatever the reason is, report or explain needs to indicate that metric is in the standard, but not reported. Metric codes is the data visible to the metric code? And the reason for that is quite clear too. It's to help the reader, it's to help the user of the data find what they're looking for, to be able to compare between companies and over time. And remember too that today's reader is not always a human. It could be a machine reading the ESG disclosure, and to provide visible data and metric codes enables that process. And is the SASB information available in a structured format? So again, just to go over those again, just the are the accounting metrics, a few others too, are the accounting metrics reported partially or fully? That is, are any of the metrics within a topic skipped over, and are they in alignment? Is the report or explain principle used, and metric codes and visibility of data, both quantitative and qualitative? A few other characteristics, and these are sort of the, if you will, the extra elements of really outstanding disclosures. And this would really apply to any type of disclosure, ESG disclosure, not just SASB standards disclosure, but for example, time series showing multi-year data sets to show directionality of the data, or contextualization, that is having narrative disclosure, including around quantitative disclosures. The timing, how close is it to the financial reporting schedule? Any integration with regulatory filings, appropriate use of links. So appropriate use of links could be to provide extra context or color with the data through a link to other publications or within the same publication. Consistent measurement disclosure over time. And of course, disclosure really of governance and strategy and risk management, those key pillars of ESG. Now, Dan talked about the technical protocols built into the SASB standards to enable this quality. This is just one example in apparel and footwear, and looking at the technical protocols. So the technical protocols can include definitions and scope. Very importantly, they frequently include notes, that is, suggestions for extra context to give around a quantitative response. This is sometimes overlooked by companies. They'll just give the number response, and I view it as a missed opportunity to provide additional color around that number. So do look at the technical protocols for those notes. And just finally, to wrap up, to reiterate some of the best practices, and this time really through the feedback we get from investors. What do investors want? They say they want that consistency over time, and they want the time series to show directionality. They want this metrics to be supplemented by appropriate context, narrative description around, again, governance, strategy, risk management, providing a complete picture of performance. They want any omitted or modified metric or topic to have an explanation. And they want it easily accessible and structured for use by investors. So that concludes just a quick look at what some of the aspects of quality and some of the ways that the standards are structured to provide for quality. I now go back to our panel, and we're going to continue our panel discussion with Suzanne and Dan and some questions from the audience. And I'll start off with one. This is one for Suzanne, and it's a question about board oversight. So ESG oversight at the board level. And I think, Dan, you might have an opinion on this too. But the question is very simply, does board oversight belong to the audit committee? Where do you see the responsibility at board level, Suzanne?
Yeah, well, yes, I do see it as a responsibility of the audit committee for the very simple reason that the audit committee is already in charge of financial reporting. And when we want ESG reporting to be part of that whole picture by providing a 360-degree perspective on the company's performance, then that sits with the audit committee. That said, it also means, expanding the responsibility of the audit committee, and means, if you will, educating audit committee members on what does that mean. And then back to within the organization, it also means that this is a way of having the CFO on board. And that, in my view, is absolutely critical for success on this form of reporting.
And Dan, over to you. What are your thoughts on the top level at the board?
Yeah, I mean, I certainly agree completely with what Suzanne has said, and I think audit committees need to recognize that their responsibilities are broadening now as ESG disclosure becomes important. I just make a couple points about the full board as well. And first, probably the most important thing that the full board can do is show the importance that it attaches to ESG reporting. It's kind of a tone at the top issue. What's important to the board is going to be important to management. And I think that it should be something signaled by the full board, not just the audit committee. Also, again, I think we've touched on this already, but ESG disclosure isn't really an end in itself. It needs to be integrated with the company's strategy and approach to risk management. And again, that's usually a responsibility that goes beyond the audit committee. So the full board should be thinking about how the ESG disclosures relate to risk management and strategy. And then finally, I just touch again on the management performance oversight aspect, which is likely to be something at the full board level, and how that integrates now with ESG.
And Dan, I'll just read a question. I think you've answered this in full, but I think it's a great question. And why aren't boards of directors terrified by the fact that sustainability information might be disclosed without oversight or the direct involvement of finance, legal, and so on? And I think you've outlined those risks and the consequences. And I think you would agree that boards of directors today kind of are terrified, and they're really getting involved, right?
When I was practicing law, we tended to avoid using the word terrify when talking to our clients. But yes, I think that's something that people should be very concerned about, because there are serious risks in this area.
Suzanne, here's a good question for you, going on the topic of assurance. And given that assurance is expensive, is there an incremental step-by-step pathway to data reliability and quality that companies can start using around things like controls, internal audit, and agreed upon procedures?
Yes, there is. And I certainly hope that people who work in companies in these functions are not terrified of assurance, because it is a help in this process. So what we do a lot is actually what we call pre-assurance. So that is to gauge the assurance readiness of disclosures. I did touch upon it briefly before. It's a way of helping understand which are the most material disclosures, to be intentional about the disclosures you use, and also to ensure that there are indeed consistent accounting principles. And here, mind you, now that we have the SASB standards to lean on, it's much easier than when we started way in prehistoric times and we had to make our own homegrown accounting principles. So I think there's much help to be found. And then maybe just a quick comment to say we should be mindful that the reason why ESG disclosures are gaining foothold is that we all have come to an understanding that financial information is not sufficient. So it's financial information that is, if not flawed, then certainly insufficient. And the ESG data will be completing that picture, but of course need to be reliable.
Great. That's an excellent answer. Thank you, Suzanne. And that pre-assurance, I think it's very helpful for companies to understand how to get started on that pathway and how they can go through some of these exercises short of a full-on assurance engagement and attestation engagement. They can definitely get started down this path. Now, Dan, here's a good question. I think this kind of gets to the crux. One of the challenges around this whole area of ESG data or ESG reporting, and that's the challenge on the qualitative side, the narrative reporting side. And I think companies are starting to think about this in Europe with limited assurance across all ESG reporting. This is not just about just the greenhouse gas numbers or just your diversity numbers. This is about your whole report. So in terms of internal controls and assurance, how do you start thinking about this challenge of qualitative narrative reporting?
Well, yeah, I think that is a challenging question, and Suzanne may have things to add on this, but I would say that most narrative or qualitative disclosures essentially include a factual element, and that's generally going to be auditable. And if management says that it has a plan to do a certain thing, it ought to be possible to look and see if there's evidence that there is such a plan or that such a strategy is being implemented. Also, at the review level, when you're looking for negative assurance, the auditor is often going to be able to say that nothing's come to their attention that's inconsistent with qualitative disclosures or narrative disclosures that a company is making. So I think there is a lot of room for assurance, even with respect to non-quantitative disclosures.
And Suzanne, just briefly, as we wrap up, any thoughts on that, and not just qualitative narrative, but future-looking, forward-looking disclosures around ESG? What are the challenges there for controls and assurance?
Yes, and I'm just reminded of many discussions we've had about forward-looking information. This is something that some would be terrified about. But that said, we should be mindful also that in financial disclosures, there are estimates, and there also is an outlook of future performance based on certain assumptions. So as long as you can provide the assumptions, then I'm fully with Dan that it is possible to include forward-looking information, and that is what makes reporting so much more interesting and useful for the users.
Excellent point to end on, Suzanne. It's so true. Investors no longer want that backwards-looking boilerplate. They want forward-looking information about performance to help predict future performance. Well, just to finish up the webinar, let me point to some valuable resources that SASB has for reporters. And first of all, thinking about our implementation primer. This is an excellent resource for companies to look to in terms of all the steps to adopt SASB standards. And in particular, relating to this subject today, the 6th module on assessing your readiness includes guidance on data gathering, data reliability, internal control, and disclosure controls, and assurance. There are key questions to consider and a worksheet to download for each module. Moving on now, and a really great new resource is SASB's new help portal. It's got frequently asked questions. It's got an intelligent search tool to get to the complete answer library, and it has help forums. It covers the whole range of standard setting, standards content, how to use the SASB standards and licensing, as well as the whole sustainability disclosure landscape. And lastly, some other resources that I would recommend looking to that SASB makes available. Looking down the right-hand side here, Integration Insights, 25 case studies written by investors. Companies always wonder, how are investors using this disclosure, using this data? Well, these case studies tell you. Our engagement guide was written for asset managers to guide their engagements with companies. And it's also extremely useful to companies. I'd say particularly for senior management board members who might be going into shareholder engagement meetings and wondering what are the questions that are going to be coming at them. It's essentially the standards and question form. And of course, our TCFD implementation guide. I talked earlier about how GRI and SASB can be used together. We've talked a lot about integrated reporting in SASB. With TCFD, SASB is one of the most referenced standards used to implement TCFD recommendations. Well, that brings us to the conclusion of part 4, the last in our 2021 SASB implementation webinar series. Registrants will receive a link to today's replay and slide deck. Again, all your questions answered, or to reach SASB staff, go to our help portal, help.sasb.org. Thank you very much to our live audience for tuning in. Sincere thanks to SASB Standards Board members Suzanne Stormer and Dan Gelzer for joining me today. Thanks also to all the speakers in this series, and to the countless Value Reporting Foundation staff behind the scenes for their input, particularly Lois Wilkins, Shira Goldman, and Rami Johnson for their help. I'm Neil Stewart with the Value Reporting Foundation. Goodbye.